All right, what's going on, guys? So, coming to you today, Terry James, your mortgage guy. Just wanted to check in. One thing I wanted to talk about today is going to be home equity line of credit, why I love to hate them. All right, so there's a couple of things when we're talking about home equity line of credit, why they're a good thing. However, there's some things why I hate them. All right, so first we're going to start with the good, or actually, let me start with the bad, actually. So, what a lot of people do, in my experience and all the years that I've been in the mortgage industry, and what I've learned is that a lot of people are using the home equity lines to, for example, pay debt off. They're using them to buy cars. They're using them for a lot of things that actually do more damage or doesn't bring us value, doesn't bring us interest. They don't earn us money, but we take the equity in our home, with the home equity line, and we're using them for things that basically lose value, to pay debt off and all this. One thing I will say is that I don't believe, it's not one of the best things to do to pay debt off. That's just my recommendation, my personal opinion with the home equity line. Okay, the best way, in my opinion, what I'm saying and what I'm showing is going to be with the home equity line. There's a couple of things to do with them. Okay, so what you can do is you use that money. Home equity lines, why they're great is number one, you get an interest only payment, which means your payment is not going to be that high. You're able to leverage the equity in your home. So what it does, it allows you to use the equity in your home. You can pull that. Essentially, you're pulling that cash out. And now that you have the cash, what do you do with it? Okay. So one of the things that you can do with that cash is that you can actually leverage that to potentially purchase other properties. Okay. So once you have that cash out, because if you already have a home, obviously you have a home equity line. So if you already have a home, what you're going to do with it at that point is you say, okay, well, what about getting a investment property? Okay. So you take that cash out. With investment property, typically you have to put down, investments is usually 20-25%. So with that home equity line, you can use that to leverage, put down the down payment. And as far as qualifying, you can use the rental income that you're going to get from that investment property. So if you actually purchase, for instance, like a duplex or a multi-unit, oftentimes those will already have tenants in them, and you can actually leverage that. Now, when you make your purchase, you could use that rental income to help qualify you for that purchase of the investment property. Okay. Now, let's say you take out, 50,000, 100,000, whatever that is, out of your home, and you put that on an investment property. You say, okay, well, what about my interest going up, my interest rate, my payment? That's why the number one, the investment of that is automatically going to pay off in the first year. You have that interest from that you're going to earn on that home from the beginning. Let's say you buy a $400,000 home, at 5% return, you're already going to earn, that amount of dollars as far as just off the top, 5%, that first year. So what you want to do with the home equity is you want to leverage it to bring more income and to bring more investment opportunities to you. So you don't want to pay debt off, which most people do. That's been the same old thing for all these years. You do not want to pay debt off. You want to take that money out of your home and have it earn you more money. Okay. The other thing that would be beneficial, that's also a very good idea to do, because this once again benefits you, is taking a home equity line and then placing that, using a portion of that to now start paying off your mortgage. And so in a lot of cases, you can pay out your mortgage off in anywhere from 5 to 10 years with a strategy of replacing your mortgage with your home equity line. Okay, so once you have that liquidity, once you have that equity, you now can take, let's say you owe, just throwing a number out there, $300,000 on your home, you're able to pull out 100, in equity. So if you have $100,000, you now want to take a portion of it, a very large portion from the home equity line, make that payment, a principal and interest only payment on your mortgage account, okay? And then once you pay that mortgage account, let's say for the first year, you make as soon as you take the home equity line, you make a payment of, 80,000 on your principal and interest on your mortgage. What that now does is your principal balance on your mortgage now comes from 300 to now 220, right? $80,000. So that's going to start paying your mortgage off faster. Now you say, okay, well, my home equity line now is 85,000. Okay. So what you do, the strategy behind this is now when you get paid, your income that you're going to receive, you now is going to deposit all of your income into the home equity line. Okay. So when you get paid, you put that money in the home equity line. You say, okay, well, what about my expenses? Great question. So what you do is with your expenses, you now pay that out of your home equity line, okay? And so that means that your bills, your food, your gas, all your monthly expenses are now coming out of your home equity line. And most of them, if you get a home equity line that is a open-ended, which means you can pay it off, use it again, pay it off. They'll come with either a credit account or even a bank account and routing number, so you can actually ACH payments out of there. You're basically using it like a credit card, essentially, or using it like a checking account. So what you do is that you'll see as time goes on, your balance is going to be affected because that 80,000, you put your monthly, your gross income, whatever, or net income, whatever you get after taxes, you put that into that account, and instantly at the first of the month or whenever you get paid, your balance comes down, okay? Because on a home equity line, your balance is always affected by the balance, or your interest is affected, your balance is affected by the interest, whatever your balance is for that month, all right? So once you begin, you make that payment, over time what's going to happen is you're going to pay off your home equity line at a much higher rate than paying off your mortgage if you just make your mortgage payment every month. So essentially the idea behind this is that every year or two, however fast it takes you to pay your balance down again, you then are going to turn around and place another $80,000 of payment to your principal payment to your mortgage. Okay, so in a span of, I would probably guess, maybe 2 years, you should be able to pay that balance down, depositing all your income from there, making that payment. You should be able to pay off your Heloc at a relatively fast rate, even 80,000, 100,000, because the payment on it is going towards principal and it's a smaller amount than your mortgage. But within 2 years, you should be able to put at least 2 lump sum payments on that mortgage. So if your mortgage was starting out at 300, within 2 years, it's already going to be down to pretty much 180. So that's a really big deal. And what you're doing is now you're replacing your payment of your mortgage. You're now replacing the payment you're replacing your payment to the home equity line, which you can pay the home equity line off. If you deposit all your income into it, it's going to pay that off at a faster rate. And then therefore, every time the balance comes down, you now take another lump sum and you pay off your mortgage. So these are 2 things that you really want to start thinking about when you take out a home equity line. Do not use it to pay off, $10,000 of debt. You want to leverage every ounce of your home to work for you. If you use your home equity line and it's not going to work for you, then you don't want to do it. You don't want to use a home equity line for that. All right. And that's what a lot of people have done for a lot of years. And, I've seen it several times. But the benefit is you want to make that home equity line work. That is why I love to hate them. They're a very good product to use when used correctly and when used with the purpose. And it doesn't even have to be buying another home. This could be taking out the $50,000 and doing a business investment. Okay, so these are all the different things, anything that's going to bring you more money, anything that's going to give you interest earned on it. These are the things you want to do with your home equity line. Don't just pay debt off, because debt isn't going to benefit you. So you're using the equity you've earned, and now you're paying something off like a car, which automatically loses, value the moment you drive off the car lot. These things are dead money. So you don't want to be wasting the money in those areas. You want to take your home equity line and leverage it and to your benefit. And even as, depending on if you want to pay your mortgage off faster, you want to invest and get another income producing property, even if you want to look at getting an ADU built. So ADUs are becoming very popular now. They're accessory dwelling units. So what that is they are an add-on to your current home. So once again, you can add a income producing property, which I've talked about in the past on my other videos. You can use a income producing, take a home equity line, help build an ADU unit, whether that's, typically they range in price. But I know some great people, you can get some done for anywhere from 200,000, 180 and up. But you use the home equity line to get that built, right? And now what you can do with that ADU, you can actually rent that out. So even as you start to produce money off of your ADU unit, your accessory dwelling unit, you now can take that income and put it back into the home equity line to once again pay that off. Because the goal is to pay off your home equity line, because you can pay that off faster by making large payments. You can pay that off faster than you can your mortgage. So there's a lot of different ways to go about this, but the whole goal is to leverage and use the home equity line to benefit you and use it in the right way, something that's going to bring value to your future, your financial future, and increase that. All right. So I hope you guys enjoyed this. I will put in some links as far as even where you can find out a Heloc calculator, where you can pull that up from. And so, but there's a lot of things that you can do on there just to look at that opportunity and leverage it for your good and to benefit you. All right, so I hope you guys enjoy it. As always, make sure you hit like, share, comment, and make sure you hit subscribe. All right, take care.